We've all been there. You see a massive green candle rip across your screen, you jump in to catch the momentum, and the market instantly reverses, hunting your stop loss. Retail traders see these wild swings and assume a fresh trend is starting. In reality, these are often engineered volatility spikes, erratic price action designed specifically to clear out liquidity from both buyers and sellers. If you find yourself constantly caught at the top of these false breakouts, it is because the vast majority of sudden chaotic market moves are traps, deliberately set to lure in impatient retail capital. Professional, smart money traders ignore these frantic swings. Instead, they look for a specific high-velocity expansion left behind when institutions commit to a new price level. This is displacement, an energetic repricing that occurs only when the largest players are forced to show their hand. Surviving the modern market means stepping back from the noise. You have to pass every piece of raw price data through a rigid set of criteria to filter out low-energy liquidity hunts and isolate true institutional intent. This chart shows exactly what that intent looks like. Notice how a series of small average price movements, say 5 pips per period, is suddenly interrupted by a massive vertical expansion. This is the first filter, a clear break in the market's historical rhythm, proving that institutions have finished accumulating orders and are now aggressively moving the asset. To confirm this move is institutional, we look at the candle's anatomy. The solid body should make up at least 80% of the total range, leaving almost no wick at the top or bottom. Large wicks represent indecision, points where the market pushed then immediately retreated. By requiring the body to dominate 80% of the candle, we isolate moves where buyers or sellers maintained total control from open to close, signaling that the move was fueled by heavy institutional capital rather than retail speculation. If displacement is the engine of institutional trading, the fair value gap, or FVG, is the exhaust. You cannot have a high-probability displacement move without one. This diagram breaks down exactly how a fair value gap forms. We look for a specific 3-candle sequence. Notice the upper wick of the first candle and the lower wick of the third candle. Because the aggressive displacement candle in the middle moves so fast, it creates a physical gap where those wicks fail to meet. This void in the price action shows that the buy or sell orders were so overwhelming that the market never had the chance to find a counterparty at those specific prices. It is a physical footprint of institutional order flow that retail traders simply cannot generate. If you see a massive candlestick, but the surrounding candles completely overlap it and fill in the space, there is no true institutional aggression. Without the fair value gap, that big candle is a low-energy illusion. But even a structurally perfect candlestick with a wide-open gap is unreliable if it happens in a vacuum. A 10-pip displacement at 6 p.m. Eastern during the slow Asian session carries very little weight. True intent requires peak institutional volume. Valid displacement needs to align with designated kill zones, specifically the high liquidity windows of the London Open or the New York Open, when the major players are actively deploying capital at their desks. Here, we see a line graph tracking a downward trend. A genuine market structure shift occurs only when a sudden, energetic move vertically punches straight through that established historical peak. A lazy close or a stuttering wick over an old high is an immediate red flag. This calculated, forceful break of structure is vastly different from the chaotic price action you see during high-impact news events, like the release of inflation data or non-farm payrolls. Novice traders often rush into those giant news candles, assuming the big banks are making their move. To survive the news cycle, you have to apply the 15-minute time test. Wait for the first 15 minutes after the economic release to close before analyzing the chart. If the move was a genuine shift, the price will hold its ground and maintain the open gap. If it was an engineered trap, it will look like this: a violent whipsaw in both directions that collapses right back to its starting baseline. Context dictates the intent behind the move. High-volume momentum that clears an old barrier during the New York Open indicates that the market has abandoned its previous range for a new directional target. Once you isolate a valid high-energy move, you have to understand the physics of the gap it leaves behind. Major institutions deal in massive volumes. They physically cannot fill their entire position in one single transaction, forcing them to leave a cluster of resting orders sitting inside that unfilled fair value gap. This reality requires a strict psychological shift.
Spotting true displacement is not a signal to panic buy the top of a huge candle. It is a signal to sit on your hands and wait. The highest probability execution happens when you let the market exhaust its initial surge. You watch the price slowly drift backward, returning into the vacuum of the fair value gap to trigger those resting institutional orders. Only then do you enter the trade. Long-term profitability is the result of demanding stringent, physical evidence before you risk a single dollar. You let the market demonstrate its energy through speed, structure, and open gaps, entirely ignoring the temptation to gamble on erratic, balanced candles. Now it is your turn to apply this logic. Open your FXNX trading platform and pull up a 15-minute chart. Review the last 3 market structure shifts using the platform's real-time volatility tools and check exactly how many were backed by true energetic displacement. By identifying the specific imbalance left behind by displacement, you stop reacting to market noise and become a calculated participant trading directly alongside the institutional order flow.